Hi guys, Trader Michael here. In today's video I will discuss the 3 wild soldiers candlestick pattern. But upfront I must say that you should treat this video more like a research material, not a direct advice how to trade. I do strongly believe that candlestick patterns should be treated as an additional confirmation, not as a pure trading strategy. Even though it can be profitable in some cases, which I will show you later in the video. So basically, what is important in trading with candlestick patterns is first, find the pattern, and secondly, to identify the location of the pattern on the chart. The 3 white soldiers was described in the book called Candlestick Charting Explained by Gregory L. Morris. And it looks like 3 consecutive rising candles, with long bodies and small wicks or none at all. In the book it is described as a reversal pattern, but after checking a couple examples, I rather call it a continuation one. Author also wrote about 2 other related models, the advance block and the liberation candlestick patterns, but he also gave us the stats about utility of those models, and they weren't great, so I think we could leave them and don't describe them in more detail, cause simply there is no reason to do that. We should focus on important things. So let's switch the screen view and check some examples, of course. So now let's talk about how exactly the 3 white soldiers candlestick pattern looks like and how we could possibly trade based on this candlestick pattern. But as I told you, you should use it more as a confirmation, not as a pure strategy, but let's talk about either way. So as I told you a moment ago, it looks like 3 consecutive upward bullish candlesticks. So what is important? They should have a very long, very big body and very small or no shadows at all. So these are the first conditions. And another thing is that at best the first candle should be the biggest one, the strongest one, which should signal the very strong momentum. So what is important? Why the shadows are important? It is because when we see, for example, the upper shadows on these candles, it would suggest that the movement wasn't very strong because it didn't hold the maximum levels during the candlestick formation. So that is why the strong body with no shadow is the construction of this candlestick pattern. So now let's check the real example on the chart. Let's roll back. I marked them with the rectangles previously, which I was analyzing. Okay, so now we have the real example, and we see that the first one is biggest one, and 3 consecutive ones looks like this. They have very small shadows, very small wicks. So I guess we could determine them as a 3 white soldiers. So we determined the pattern. Now let's check where we should enter a trade and where should we place our stop loss. So there are basically 2 or maybe 3 ways of entering a trade. The first one is the one I would recommend is at the beginning of the opening of the next candle, which is the 4th candle, right? So it would be right here. The second way is to wait for the retracement, a small correction, because most often it occurs, not always, but it occurs. And wait, for example, for the level of the half of the entire movement, which would be somewhere over here, right? So that is the second way. And the third way, which I think it is the best in my opinion, is to first open the small trade at the beginning of the next candle, and smaller than the regular one, and the additional position I would open when the retracement occurs and then add to the whole trade. So that's basically how I would play this scenario. So the stop loss, as you probably deduct, would be below the entire formation. So I'm always adding a 1 point plus spread to the distance between the stop loss and the lowest point before the formation. So that is the first example, and let's talk about where this is placed. So as I told you a moment ago again, that it is a continuation pattern, so we shouldn't look for it at the support and resistance, rather somewhere in the middle. So as you can see, I have also a couple other examples marked to talk about, but as you can see, we had this downtrend, the correction for this downtrend, and right in the third quarter, somewhere around, we have the continuation pattern. And for this example, if we would take the risk-reward ratio 2:1, I guess it didn't reach the take profit level. Yep, it didn't. So as you can see, this is the perfect example why you shouldn't rely only on the candlestick pattern itself. It should be an additional confirmation. So let's check another example, which is right here. Again, it is not purely on the support level. It is a little bit higher. We saw the first movement, correction, another movement, correction, and then the new highs made with the candlestick pattern. And we see 3 green candles. The first one, we could argue it wasn't the biggest one, but it almost had no shadow, and the other two also had very small shadows, so that is why I consider it as 3 white soldiers. So again, let's check entry point. Here, as you can see, we didn't see the pullback. It went straight upward. So that is why I told you to, one of the best ways is to open immediately at the opening of the next candle. Don't wait for the retracement. And to open a little bit smaller position and then eventually add to that, if we weren't right this time. So that was our entry and stop loss level, 1 point plus spread, and 2:1 risk reward ratio. It is visible without the measurement, but yeah, let's do it anyway. It reached this level. It went even higher, right? So let's check the last one, which is this one. I made a few more, as you can see. Basically, through the year that I tested, from the April 2021 to the April 2020, I had 17 examples, which I will share with you. With the result I will share with you after we talk about this last example, which is this one. So again, guys, as you can see, we have this time a bigger first candle, consecutive green candle, and the third consecutive with relatively small shadows. So that is why I consider them as a pattern. And it is not purely, we had this a steep downward movement, downtrend, support right here, first movement, and then strong confirmation. And as you can see, again, we had the retracement, the small correction to the whole movement. So again, let's check entry point. We could add again somewhere over here in the middle, and our stop loss would be here or here. But I was backtesting based on this stop loss to have this risk reward ratio. And again, let's measure it. 2:1, the first and the second. And as you can see, this one was a failure. It didn't reach the take profit completely. So what is plus from this particular example is that we could possibly move the stop loss at least towards the entry level, so we could we could break even from the situation not to lose any money. So yeah, I think based on that we had 1-to-1 at least risk reward ratio, we could move the stop loss very easily to the break-even point. So yeah. And again, the backtest I made on a 1-year time period, and it took 17 trades, from which 11 was profitable and 6 was negative results, gave negative results. So it had a 64% profitability. So with the risk reward ratio 2-to-1, I think it is even enough to consider it an interesting thing to add to your portfolio of movements. And it was made on a 1-hour time frame and on Euro USD currency pair. And I know maybe 1 year is not a very long time, but hey, I think it's at least a decent amount of time to consider it interesting to take it for a longer spin to test it on a wider time period. Okay guys, I need to remind you again that you shouldn't trade solely based on this, only on this candlestick pattern. It should work as an additional confirmation to your strategy. So guys, I hope it was at least a little bit interesting, and yeah, thank you for today and see you in the next video. Take care, bye.